So, have you ever found yourself scrolling online, maybe through those communities, talking about financial independence, and just wondering what it really takes, to get ahead?
Oh, definitely. You see discussions about Henry's high earners not rich yet, or people trying to retire early, sharing like money mistakes, asking about debt.
Right. Or even questioning if being wealthy actually makes you happy. Feels like everyone's on this quest.
It's pretty universal, yeah.
Well, today we're going to dig into those exact kinds of discussions. We'll cross-reference them with the big ideas from Robert Kiyosaki's book, Rich Dad, Poor Dad.
The classic. It definitely sparked a lot of conversation.
Exactly. So our mission today is basically to pull out some real, actionable stuff from all this. Help you understand the core financial ideas, maybe spot opportunities you hadn't thought of.
And maybe challenge some beliefs about money you've held for a long time.
Precisely. We'll look at assets, liabilities, Kiyosaki's way. Anyway, the power of corporations, which is fascinating, and the real cost when people don't understand finance, financial illiteracy.
It's a big topic. Okay, let's dive
All
in.
right, so let's start right at the core. Kiyosaki's book, it's built around these two father figures, right? His rich dad and his poor dad. And it's not just that they earned different amounts.
No, not at all. It was fundamentally different mindsets, different ways of looking at the world, especially when it came to money.
Yeah.
And Kiyosaki said having these two really strong but like opposite influences wasn't confusing. It actually forced him to uh, think more, compare, and then choose for himself.
Hmm. That process of thinking critically was the key, not just accepting one view.
Exactly. And you see it in their core beliefs. One dad would say, the love of money is the root of all evil. Classic line.
Right.
But the other one believed the lack of money is the root of all evil. Totally different starting points.
Wow. Yeah, that sets up completely different approaches to life, doesn't it?
Absolutely. They're not just sayings, they shape how you act financially.
So for you listening, the idea here isn't really to say, okay, rich dad was right, poor dad was wrong. It's more about taking in these different perspectives.
Yeah, challenging your own assumptions.
Right, and using that to figure out your own path, your own financial thinking that works for your life and your goals.
It's about gaining perspective.
Okay, so these different philosophies, they obviously lead to different actions.
Mm.
And for Kiyosaki, the absolute first step, his rule number one for thinking like his rich dad, is knowing the difference between an asset and a liability.
Mm-hmm. And then focusing on buying assets.
But here's the kicker, right? His definitions.
Mm.
They might just make you rethink everything you thought you knew.
Yeah.
They can be, well, counterintuitive.
They really can be. And it's important to know he designed these definitions more for, let's say, psychological impact than strict accounting rules.
Okay. So what are they?
Super simple. An asset is something that puts money in my pocket. A liability is something that takes money out of my pocket. End of story for him.
Puts money in, takes money out.
Yeah.
Okay.
And his big argument is that the poor and middle class spend their life acquiring liabilities that they think are assets.
Ah, okay. So what's an example of that? What do people think is an asset, but in his view, isn't?
Well, the big one, the really controversial one, is your own home, your primary residence.
Whoa. Okay, hold on. Most people see their house as their biggest asset, their main investment. How does he argue it's a liability?
It's all about that cash flow definition he uses. Think about your house. You've got mortgage payments, right?
Yep.
Property taxes, insurance, maintenance, utilities, all that stuff.
Takes money out of my pocket every month.
Uh-huh.
Okay, I see where he's going.
Exactly. It's a constant drain on your cash flow. Now, he admits, most accountants and financial professionals do not agree with these definitions from a formal accounting perspective.
Right, because on a balance sheet, it has value.
Sure. But Kiyosaki stressed that these simple drawings, these simple ideas, were the start of strong financial foundations for two young boys. It's about changing your mindset.
It forces you to be really honest about whether something is making you money or costing you money day to day.
Precisely. Is your stuff actually building wealth, or is it just creating expenses? That's the core question he wants you to ask.
That is a powerful reframing. So if you're listening, maybe take a minute later and think about your own stuff through that lens. That car, even your house. Is
Yeah.
it putting money in or taking it out?
It's a really useful exercise.
Okay, this leads us straight into his concept of the rat race. That image he paints of just get up, go to work, pay bills, repeat.
Get up, go to work, pay bills.
Yeah, it's exhausting just thinking about it, and so many people feel trapped in exactly that cycle.
Why? What drives it, according to him?
He says it's basically run by two core emotions, Fear and greed.
Fear and greed. Okay, how so?
Well, the fear is obvious, right? Fear of not paying your bills, fear of getting fired. That fear pushes you to cling to your job, even if you hate it, just for the security of the paycheck.
Makes sense. And the greed. That's the desire for more. You get a raise, and instead of investing the extra, the desire for nicer things kicks in. Greed makes you want a bigger salary to buy more stuff.
The lifestyle inflation trap.
Exactly. Think about the dream home scenario he describes. A couple gets raises, their income goes up. What do?
Buy a bigger house.
Right. Bigger house means higher property taxes, maybe a new car for the new driveway, new furniture. Their liabilities just balloon. Mortgage debt, credit card debt.
And they might even roll other debts into the mortgage, thinking it's smart because the payment is lower, but it stretches out forever.
Precisely. They're working harder and harder just to pay for all the liabilities they've accumulated. Kiyosaki even points out hidden drains like payroll taxes, Social Security, Medicare. It looks like 7.5% taken from your check.
Yeah.
But your employer matches that, so it's really 15% coming off the top based on your earnings, and then you still pay income tax on that original higher amount you technically earned but never saw.
Wow, yeah, you don't think about it that way.
It's a double hit. And it all feeds into what he famously said. So many financial problems are just caused by trying to keep up with the Joneses.
That pressure must be even worse now, with social media constantly showing curated perfect lives.
Oh, absolutely. Constant comparison.
So, okay, if someone's listening and feeling like, yep, that's me, stuck in the rat race, how do you get out? What's the escape route?
The core idea, the fundamental shift Kiyosaki pushes, is simple to say, harder to do. Learn how to make money work for you instead of you always working for money.
Okay.
By consciously, deliberately focusing on building your asset column, buying things that generate income, not just working harder to afford more things that cost you money, shift from being primarily a consumer to being an investor.
Right. Focus on buying assets, not liabilities disguised as assets.
That's the escape hatch from the rat race.
So if the rat race is about earning just to pay for liabilities, how do the wealthy really break free? You mentioned Kiyosaki talks about the biggest secret of the rich.
Yeah.
What is that?
Ah, yes. For him, a massive piece of the puzzle is understanding and using corporations.
Corporations, like setting up your own company.
Exactly. Or using corporate structures. He argues it's a key tool the average person often overlooks or misunderstands. The real power comes down to cash flow. Again.
How does the cash flow differ?
Okay, think about a typical employee.
Mm.
The money flows like this.
Mm.
You earn it, then taxes get taken out, then you spend whatever's left. Right?
Yeah, taxes come out first, usually.
But for a corporation, the pattern is different. The corporation earns revenue, then it spends money on legitimate business expenses, and only then does it pay taxes on whatever profit is left over.
Earn, spend, then tax. The employee is earn, tax, then spend. That order. It seems small, but I guess it makes a big difference.
Huge difference. Because the corporation gets to pay for many expenses with pre-tax dollars, things an employee pays for with money that's already been taxed.
Like what kind of expenses?
Well, legitimate business expenses, of course. But think about it. A business trip to Hawaii could be framed as a necessary board meeting. Car payments, insurance, maybe health club dues, lots of meals. If they're legitimate business costs, the company pays for them before taxes are calculated.
Wow, okay. While an employee pays for their vacation, their car, their gym membership with after-tax money.
Precisely. Plus, corporations and trusts offer legal protection. They can shield your personal assets if the business gets sued. Kiyosaki talks about how the rich often control everything but own nothing personally. The assets are held in trusts or corporations.
So it's both a tax advantage and a legal shield.
Exactly. It's why he says a person who understands the tax advantages and protections provided by a corporation can get rich so much faster. It's like the difference between someone walking and someone flying.
That's a powerful analogy. It really
Yeah.
shows how it's not about not paying taxes illegally, but about using the legal structures available to play the game differently, more strategically.
It's about understanding the rules of the game the wealthy often use, playing it smarter within the law.
Okay, connecting these ideas from Kiyosaki to the broader world, it really shines a light on a huge underlying issue, financial illiteracy, tax illiteracy too.
Oh, absolutely.
And this isn't just some abstract problem. It has real measurable costs, doesn't it? affecting everyday people.
Huge costs. If you look at the bigger picture, there are estimates. I think for 2023 in the US, insufficient financial literacy costs something like $388 billion.
Yes. $388 billion.
Yeah, it breaks down to over $1,500 per adult. Just gone, effectively, due to lack of knowledge. And these aren't like minor slip-ups. They're often systemic drains on people's finances, making it harder to build wealth.
And it probably widens the gap between those who understand the system and those who don't.
Definitely. Knowing tax law, for instance, isn't just about avoiding penalties. It's almost like having a superpower for building wealth. You know the cheat codes within the game, legally.
So what are some common mistakes people make because of this lack of literacy?
Well, the sources we looked at highlight quite a few. For instance, many low-income families miss out on thousands in tax credits, like the child tax credit. They just don't know how to claim it, or even that they're eligible.
That's money left on the table.
Absolutely. Or think about self-employed people, maybe a rideshow driver. Like in one example, they might have no idea about paying estimated taxes quarterly.
Right, and then get hit with penalties.
Exactly. Or they don't keep good records for deductions they could take, like mileage or a home office space. That's direct income lost because they don't know the rules.
And it's not just about deductions, is it? I remember reading about people misunderstanding refunds.
Yeah, that's a big one. Something like 28% of people in a survey thought getting a big tax refund was actually a good thing.
But it just means you overpaid all year, right? You give the government an interest-free loan.
Precisely. It shows a basic misunderstanding of cash flow. That money could have been working for you all year long. Instead, you lent it out for free.
Okay, what else?
There's confusion between filing an extension and getting an extension to pay very different things, leading to penalties.
Yeah.
And worryingly, a big jump in people using those high-fee refund anticipation loans. A 33.6% increase in 2023. People taking expensive loans just to get their own money back faster, often because they don't grasp the cost.
Ouch. Those fees can be brutal.
They really can. These aren't just theoretical problems, they're real pitfalls hitting people's wallets hard.
It's so clear that just working harder isn't enough if you don't understand the financial game you're playing.
Exactly. Which leads to another key Kiyosaki idea.
Right, the one about mind your own business. And again, it's not what it sounds like initially, is it? It's not about being nosy.
No, not at all. It's about making a crucial distinction between your profession and your business.
Okay, explain that. Profession versus business.
Your profession is what you do to earn a paycheck. You might be a banker, an engineer, a teacher, a podcaster. That's your job. Your business, according to Kiyosaki, is the activity of building your asset column. That's your real business. And he argues most people focus entirely on their profession,
Working hard for someone else's business.
while completely neglecting their own business of building assets. It's a strategic blind spot.
So how does that play out? Does he give an example?
The classic one he uses is Ray Krocus, the guy behind McDonald's.
Okay, the Hamburger King.
Well, Krocus' profession, what he actively did day to day, was selling hamburger franchises. That was his job.
Right.
But his real business, the thing that built the massive wealth, was real estate.
Real estate. How?
He wasn't just selling the franchise. McDonald's Corporation was buying or leasing the land underneath those restaurants, the most valuable corners, the best locations. His business wasn't burgers. It was prime real estate.
Wow. Okay. So McDonald's became this huge real estate empire disguised as a fast food chain.
Pretty much. That's what Kiyosaki calls secret number 3 of the rich. Having that focus beyond just your salary on building your own income-generating assets.
So it's about shifting your main focus from just the paycheck to actively building things, real estate, stocks, intellectual property, whatever, that make money for you.
That's the core of it. And it ties into another rich dad rule. Buy luxuries last.
Don't buy the fancy car until your assets are paying for it.
Essentially, yes. First, build up assets that generate income. Then, use the income from those assets to buy the luxuries. Don't go into debt for them up front.
That requires discipline.
It does. Because, as he puts it, financial struggle is often just the direct result of people working all their lives for someone else and ending up with no real assets of their own to show for it.
That definitely challenges the work hard, earn, then treat yourself mentality that's so common. Delaying that gratification to build assets first. That's tough psychologically.
It is. It requires a different mindset.
Which brings us nicely to developing what he calls financial IQ. It's not just about knowing facts, right?
Yeah.
It's more holistic than that.
Absolutely. It's about skills, mindset, resilience, the whole package needed for financial freedom.
So what does he say makes up this financial IQ? What are the components?
He breaks it down into four main areas of expertise. First, accounting, basically, financial literacy, being able to read numbers, understand statements.
Okay, know how to read the scoreboard.
Second, investing the science of making money, strategy.
Right.
Third, understanding markets, knowing about supply and demand, economic factors, market trends, both the big picture and the specifics.
Makes sense. And the fourth?
The law, understanding things like tax advantages, corporations, legal ways to protect your assets. We talked about that earlier.
Got it. Accounting, investing, markets, law. That's a lot to learn.
It is. But here's a key point he makes. It's not so much the lack of technical information that holds us back, but more the lack of self-confidence.
Ah, so it's often fear or doubt, not lack of knowledge.
He really believes that. He says it's not the smart who get ahead, but the bold. People who take action, even if they make mistakes.
That's interesting, because we're often taught to avoid mistakes at all costs.
Right. But Kiyosaki flips it. He says, in the real world, people who take action are the ones who make the most mistakes and learn from them to win. Mistakes are data points.
Like Thomas Edison with the light bulb filament.
Exactly. Edison's quote, "I did not fail 1,014 times. I successfully found out what did not work 1,014 times. It's about resilience and learning."
And you see that in other stories too, like Colonel Sanders.
Oh, yeah, amazing story. Loses his business at 66, living on Social Security, gets rejected, over 1,000 times trying to sell his chicken recipe.
Over 1,009 times, apparently, before finally succeeding with KFC. That's incredible tenacity.
It really is. It shows that boldness, that willingness to keep going despite setbacks.
So how do you build that financial IQ and overcome the fear? Does he offer practical tools?
Well, one really interesting thing he developed was the cash flow game. It's literally a board game.
A board game to teach finance.
Yeah. It's designed specifically to teach these principles in a safe space. You use play money, so you can make mistakes, try different strategies, investing in stocks, real estate, starting businesses within the game without real-world risk.
So you learn by doing, simulated doing anyway.
Exactly. It helps develop creative financial thinking. The game also introduces his ESBI quadrants.
Right. E for employee, S for self-employed or small business.
B for big business owner, and I for investor. The game helps you understand how cash flows differently in each quadrant and encourages thinking about how to move towards B or I, which he sees as the wealth-building quadrants.
So it's educating the whole person, intellectually, emotionally.
Mind, body, emotions, spirit, as he puts it. It makes learning active and engaging.
And one more point you mentioned earlier about mindset. Rich Dad didn't believe in being balanced.
No, he thought balanced people go nowhere. He advocated for focus. If you want to achieve something significant like Edison with the light bulb or Gates with software, you need intense focus, not trying to balance everything equally.
Concentrate your efforts. Okay, that really encourages a proactive, almost experimental approach to finance. See challenges as learning moments.
That's the idea. Be bold, take action, learn, adjust.
All right, as we start to wrap up this deep dive, let's just quickly recap the big takeaways we've hit on today.
Okay. Well, first, that fundamental Kiyosaki distinction. Assets put money in your pocket, liabilities take it out. Changes how you view everything you own.
Right. Then, the power of corporations using them legally for tax advantages and asset protection. A key strategy.
Definitely. We also touched on the very real, often hidden costs of financial illiteracy and why continuous learning is so crucial.
Can't afford not to learn, really.
And finally, the mindset piece. Overcoming fear, embracing action, learning from mistakes, and focusing your energy on building your business, your asset column.
Yeah, it's a whole package. And maybe a final thought to leave everyone with. This one's from Kiyosaki. Money is only an idea. He says, there's a great book called Think and Grow Rich. The title is not Work Hard and Grow Rich. Learn to have money work hard for you, and your life will be easier and happier. Today, don't play it safe. Play it smart.
Play it smart. I like that. So if this conversation got you thinking, maybe consider what part of your financial knowledge could use a bit more attention.
Yeah, maybe check out resources like richdad.com, connect with others learning this stuff, or even find a way to play that cash flow game, see how these ideas feel in practice.
Good suggestions. Keep exploring.
Absolutely. Well, that's all the time we have for this deep dive. We really hope this exploration gave you some valuable food for thought for your own financial journey.
Yeah, hope it was helpful.
Until next time, keep digging, keep learning, and keep growing.